Hello, all you clever capital investors. It's time to put the fun in fund structures. See what I did there? Today, we're going to break down the different types of real estate fund structures. Think of it like choosing a ride at an amusement park. You want something that's thrilling, safe, and fits your style. So let's buckle up and explore the roller coaster of real estate fund options. Okay, what is a real estate fund? A real estate fund is a type of investment vehicle that pools capital from multiple investors to invest in real estate assets. These funds can be used to invest in a variety of property types, including residential and, of course, commercial, especially my fave, triple net retail. And the main goal is to generate income and potential equity appreciation for the investors, such as yourself. So, the type of real estate fund structures. Let's start with the most common type of real estate fund that I'm sure you've all heard of before, real estate investment trusts, also known as REITs. They're basically companies that own, operate, or finance income-producing real estate across a range of property sectors. So basically, there's no value add, there's no renovation, which means there's no upside. They're just income-producing type of properties. There's publicly traded REITs, which are listed on the major stock exchanges and bought and sold just like stocks. So they offer that high liquidity and are accessible to everyday investors. Now there's non-traded or private REITs as well. So those are obviously not listed on the stock exchange and they provide less liquidity, but are often targeting higher returns and are suitable for investors willing to lock in their money for longer periods of time. Okay, private equity real estate funds. This is where the real fun begins. Think of these structures like different types of vehicles or cars. Some are good for short trips, others are good for long road trips, and some are even fun to do off-road ready type of things. So let's start with Reg A. This is kind of like your everyday sedan. It's a great option for a lot of people because they have much lower investment amounts and you can solicit or advertise these offerings to the public. It's also open to both accredited and non-accredited investors. However, there is a lot of regulation and reporting involved, and it takes a long time to set up from a fund manager's perspective. So the next up is a Reg D 506B, as in Brittany. We can call this a Reg B for now. This is like your sports car. It's designed for speed and performance, but it comes with a higher price tag and much stricter regulations. So this allows fund managers to raise money from an unlimited amount of accredited investors and as many as 35 non-accredited investors. So those are usually like your friends and family. However, the non-accredited investors must be quote unquote sophisticated investors. You're also not allowed to publicly advertise, which is a huge deterrent for a lot of fund managers because who wouldn't want to advertise? Now, a Reg D 506C, my fave, or what we can call a Reg D, is like your trusty old pickup truck. It's versatile, reliable, and can handle a variety of tasks. A Reg D allows fund managers to raise an unlimited amount of capital from accredited investors only. Okay. Finally, there's a new kid on the block that has emerged over the last 10-ish years. I know it doesn't sound that new, but it is new in the bigger scale of things, which is the Reg CF, or regulation crowdfunding. So crowdfunding platforms exist online and allow investors to invest directly online to invest in specific real estate projects or even portfolios. So this model has gained popularity due to its accessibility and much lower investment minimums. Also, with these various structures, there's two different types of capital commitment periods. There's close-end and open-end. Let me explain. Close-ended funds, these funds have a fixed capital commitment and an investment period. So once the fundraising is complete, the fund is closed, no new investors. They have a specific exit strategy, such as selling the properties at the end of the fund's life or refinancing them. There's open-ended funds as well. So these funds accept new investors continuously and allow for periodic redemptions, meaning periodic ways of giving your money back. So they're more flexible, but may offer lower returns compared to closed-end funds due to their liquidity provisions. So it just depends on where you're at in your liquidity needs. Now, a fund is different from a single asset syndication. Syndications are partnerships where multiple investors pool their capital to invest in a specific address or real estate project. Whereas a fund, it could be a blind pool fund where there's multiple properties, you don't really know which ones, versus a single asset syndication, specific property address. So when choosing a fund structure, there's a few things you want to consider to wrap it all up. Liquidity. Consider how easily you can access your money. Publicly traded REITs and mutual funds offer high liquidity, while private equity funds and non-traded REITs may lock up your capital for years, but you're probably going to get a higher return. Speaking of which, there's risk and return. So evaluate the risk level and the potential returns. Private equity funds and syndications might offer higher returns, but they come with much higher risk and less liquidity. Of course, there's management and fees to look at, so understand who manages the fund and what their fee structures are. Professional management can enhance returns, but fees impact your overall profit, so make sure you really read that PPM. Okay, minimum investment. So this is just to be aware, there's minimum investment requirements. They vary depending on the type of fund structure. Crowdfunding platforms usually have much lower thresholds. You can invest as little as $1,000, whereas private equity and private capital have much higher thresholds, like 100K or so. Investment strategy. So ensure that the fund's strategy aligns with your investment goals, whether it's income generation, capital or equity appreciation, or a mix of the both. These are all the things that you really want to dive into. So basically, choosing the right real estate fund structure is crucial for successful investing, especially if you're not in a position to necessarily diversify. By understanding all these different options, whether it's a REIT, private equity fund, mutual fund, syndications, crowdfunding, I mean, I can go on and on. I gave you a little list of the few. You can make informed decisions that align with your financial goals and, of course, your risk tolerance. Thanks for watching. If you found this video helpful, please give it a thumbs up. And don't forget to subscribe to the channel for more alternative investment insights. And I would love to hear from you. So feel free to leave your questions, your comments, anything you want below. And if you're tired of being single and would like to learn more about earning double-digit returns through any of our alternative investment opportunities, you can learn more by going to clevercapitalfund.com. Until next time, I'm Brittany Schulman. Be clever with your capital and happy investing. See you later.